Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the lead portfolio manager for Fundstrat's U.S. Large Cap Granny Shots ETF. This is our update for the Granny Shots ETF for the week of June 11th. Let me start with some particulars. As of the end of June 10th, the price of Granny Shots was $21.35, net asset value of $21.37, and total assets of $1.2 billion. For the past week, Granny Shots has gained 1.13% compared to a 0.89% gain for the S&P 500, which is relative outperformance of 24 basis points. Year-to-date, Granny Shots is outperforming the S&P total return by 435 basis points and 944 basis points in the last 12 weeks. I'm going to start this video by going over some stock performance of the Granny Shots portfolio. And the name I want to start with is Tesla, because as you recall last week, Tesla had a terrible week because of a feud between President Trump and Elon Musk. And on that Friday of the close, you could see Tesla closed down 14%. Now, our advice to investors was that Tesla had so many advantages, from manufacturing to full self-driving to robotics and AI, etc., that we thought the stock would quickly recover. And in fact, at the start of this week, the feud does seem to have ended between President Trump and Elon Musk. And Tesla stock actually recovered almost all the losses, up 20% for the week. Now let's look at the broader Granny Shots portfolio. The top 5 performers in the past week have been KLA Tencor, Alphabet, Oracle, Palantir, and Cadence Design Systems. Now, KLA's rally is really because semis have been doing really well. And I think semis are doing well because the trade war between the US and China is largely over. And in fact, semiconductor stocks look like they are about to break to all-time highs, which is a good sign. Now, in terms of the worst performers, it's Apple, GE, Costco, Intuitive Surgical, and Progressive Corp. Progressive's, I think, suffering because insurance rates aren't rising the way they were last year. So that is having some headwinds for them. But still, year-to-date, Progressive is up almost 10%. In terms of styles, the best performing style factor was global labor suppliers, led by KLA Tencor and Google. But that's good to see here because that's a risk-on portfolio. Seasonality also outperformed, as you can see here, outperforming by 120 basis points, led by Google, Palantir, Cadence, and CrowdStrike. Okay, well, that gets us to the macro. And I think the key macro to me is, it's very obvious, risk appetite's been improving. I know this has been a rally that has been hated, but let me just give you 3 things that tell me risk appetite's improved, or should be improving. If you're cautious, you should be less cautious. The first is that Bitcoin is made all-time highs, and it's a leading indicator for the S&P 500. So I think that equities are going to follow this all-time high in Bitcoin. And Bitcoin's rise has a lot to do with central bank liquidity, which I think Real Vision has laid out for some time, and it's been very useful. The second sign of risk appetite improving is small caps. I mean, they've broken the downtrend versus large caps here. As you can see, that upside breakout is good. And I think it's really being confirmed by Ethereum, which is a smaller cryptocurrency relative to Bitcoin. It's the second largest. And as you can see, they've moved together kind of in sync. And the rise in Ethereum is confirming the upside break in small caps. Now, there's many other signs, but the third one I want to highlight is that IPOs are back. There was 103 billion of IPOs in May of this year. It's the highest in actually several years. And in June so far, we've had some big ones, like the Circle IPO, which is the stable coin. And that's actually gained 180% since its IPO. And then on Wednesday evening, Chime priced its $700 million IPO. So bottom line, I think that this is still the most hated rally, but I think it means there's still upside. It is, again, as you can tell, you could look around, you've got many people who are skeptical. Skepticism is not a sign of a top. That's a sign of markets that have a lot of firepower left. And as you know, this hated rally is not a surprise. The COVID rally was hated. The 2022 rally post Jackson Hole was a hated rally, and people only turned bullish once markets made a new high. So just be glad that there are people who hate this rally. It's bullish for stocks. And I do think the outlook for stocks is better next year than it was in February. I've kind of covered these before in prior videos, but the tariff visibility is better. There's tax and deregulation visibility. The Fed's more dovish in 2026, and companies survived a major stress test. But I want to explain that again. We had a COVID shutdown, but companies survived. Well, that's good for PE because they survived a stress test. We had a bullwhip supply chain hit companies in 2021, but they survived that. Then companies survived this massive inflation cycle without seeing margins collapse. They survived the fastest Fed rate hikes in history. And they survived this Cuban Missile Crisis-like tariff global disruption. To me, 5 of 5 crises in 5 years is an argument for why PE should be going up for the S&P companies. And that's how we're going to follow this, especially through our Granny Shots model. Thanks for listening, and I'll speak to you soon. 오늘도 돈 벌래 돈